issue, as I understand from yesterday, is that the reopening trade is creating a demand spike, leading to a mismatch in supply and demand. Their view is that those transitory factors will eventually subside and the rate of inflation will slow down. What is your thought process on this? I mean, do you agree, or do you think that this is going differently?
Well, what I see developing in the market, Fed's transitory versus people that are coming out vocally that think transitory is crazy and dangerous way of approaching this. On the list of people, including myself, that think transitory is not the right approach to this are Jamie Dimon, Paul Tudor Jones, and I forget his first name, Mr. Weir, who is the CEO of Trafigura, the biggest commodity trading shop in the world, right? I just listened to, there was a Trafigura conference call, an earnings call that I listened to that was absolutely astounding to listen to. The CEO basically said that he could see a 10-year bull market in commodities ahead of him. They've seen tremendous, renewed, new client interest in the metal space. They see the green economy driving for metals, energy, and all kinds of rare earth and difficult to acquire base metals, if you will. And they also said that they don't think that the economy is ready for the full electrification of vehicles. So I try to listen to the people that are in the actual trenches, Rajiv, rather than, sort of impose my view on the markets or the world. But I tend to go along with people like the CEO of Trafigura and Paul Tudor Jones, who are saying that, now is a really important time to hedge your portfolio against inflation. In the big picture, the big plain vanilla, slow moving funds here in the United States are still largely positioned for massive liquidity, zero interest rates, commodity deflation, transportation deflation, debt deflation. And so this is how their books with billions and trillions of dollars are positioned. And I think that as the world changes before our eyes, that they're going to have to pivot into more inflationary type of book, where I think that they're going to have to sell some of their, long-held technology positions, some of their legacy technology positions. Because when you look at the world very logically, how is it going to get any better for Amazon than a global lockdown? How is it going to be better for Facebook than when everybody is locked down at home bickering about COVID and vaccines and everything that came with this episode? So, that just logically to me matches how the stocks sort of put in a top, and technology now has really struggled to perform this year. It just picked its head up as yields backed off in the last couple of weeks. But if we were talking about the subsectors of technology 2 weeks ago, we would have been talking about sectors that were flat to down on the year. And this is with XME up 45%, XOP up 65% on the year. And I think that as you start to register more and more months and years of the markets doing this, where, oh boy, we've got a copper rally through 10K. We're going to start with the green movement that's going to basically take 10x our copper consumption. We're going to start that consumption with a very steeply backwardated copper curve, which means that supplies are tight and a record high price, right? And we're saying, okay, everybody, go build your green economy with pounds and tons of copper. And it's just not there on the shelves, right? So I do believe that there will be back and fill with this trade that, rallies to new highs and then backs off, because when you've got increased volatility like this, we're not going to have a linear path to a new high. Rather, there will be fits and starts. We'll have opportunities like this when the Federal Reserve is actively, what I think, engineering a dollar rally so that they can cool off gold and cool off silver and say, see, guys, we've got the world right. This doesn't look like inflation is scary. I mean, the gold price is collapsing. We can't even talk about inflation with the gold price collapsing, can you? It's very difficult to make a case, believe me. But you can point to the oil market and say, well, oil is 72 bid on the highs and not backing off a dime. You can point to aluminum and zinc, which are still holding their rallies. You can point to the grain markets and, God forbid, the meat markets and say, the Fed's not going to be able to supply that. You know, I look at it and I say the Fed can control the yield curve. The Fed can't sell corn. And so, you know, this is the side of the trade that I want to latch onto. And maybe that's why I sort of choose to stay out of the fixed income markets, Rajiv, if you will. I don't like to be in a position where the Fed can just flatten me like a bug. And I know that that's my risk with trading fixed income and trading FX. So what I do is I put those up on my dashboard as my speedometers. And I sit here and I trade the commodities and the commodity stocks because they're much less susceptible to the Federal Reserve and the jawboning, et cetera, et cetera. So I kind of disagree with the transitory theme. These markets are going steeper in backwardation, which just means tighter and tighter supplies. And the demand is the line for demand is out the door. Whether you want to talk about the demand in form of cyclical recovery of the economy, you want to talk about the demand being the installation of the solar panels and batteries and windmills. What we're doing is we are consuming natural resources from Mother Earth at a rapid pace right now. And that's what you're seeing. I think it's just starting to unfold, quite honestly.